Oh, certainly. I think it will cause all sorts of discussion and some tension between your traditional sort of Germany or even France versus your Italy and some of the other countries who have been pushing back against this sort of tighter austerity and fiscal policy. So I think certainly something to watch. I think the risks of Italy leaving the euro have certainly subsided given the fading rhetoric from the leaders in Italy, as well as the fact that it is such an integrated financial system. Germany and France can't really let Italy just sort of walk out of the financial and monetary picture. So I think there's going to have to be some middle ground that's achieved, though that will cause volatility in the markets until something is achieved, or at least that can is kicked further down the road.
Sometimes we care about Italy and sometimes we don't. But let's face it, the economic fundamentals don't change that quickly. In fact, they're very, very similar throughout the financial crisis. There's been a mild improvement. Of course, the PMIs were better, and now they're slowing down a little bit as well. So the investment implications, you've mentioned one, a little bit more volatility. Do you expect this to actually be one of the big thorny issues for the second half of the year?
I think if you have to compare between, let's say, trade issues that will affect the broader range of European countries and really hit some of the big industrials or manufacturers within Germany and the rest of Europe, I would rate the trade tensions higher than the Italy risk. But again, if Italy does bubble up, then it might overshadow the trade issues. At the moment, I would lean towards trade being a tougher issue because autos are still in play, and autos are a huge part of the broad European situation. Like 6% of total employment, about 13 million jobs, indirect and direct, are related to the auto sector. So this could be a bigger issue in the near term, given how the Trump administration escalates.
All right.
Yeah, I think it will be very interesting to watch now that we know that the ECB has given us a plan on how they want to reduce their monthly buying program, and obviously they've given us an indication when they would like to raise rates, to watch the spread between Italian government bonds and German bonds, because that's where the stress will materialize first. And it will be interesting now without the safety net of the continuous ECB buying program, how far the market will test the resolve of the political network on what they're going to do.
Contagion. I mean, is, given everything that's been done on a regulatory level, on a improving capital buffers level, and just improving frameworks generally, is the impact from an Italy implosion, if that were to be the worst case scenario, is it as great as it perhaps was 7-8 years ago?
No, I would think it is less, and I would think that implosion is probably a bit of an exaggeration, because we should not forget that although we think it has been a shallow improvement, if we look about the budget and current account deficit that has been approved, it's a surplus now, so the starting position is stronger. Yes, we are all worried because obviously they try to spend without having the income on the other side, and that we know will then lead to a higher debt to GDP, and this after a phase where for the first time the debt to GDP ratio has stabilized, is coming down a little bit. Now all of a sudden they want to add back to it, and that's obviously will raise all sorts of alarm bells. It's tiny, but you know, if you after the huge ramp up,
so
it has
from
been
what,
at least
131 to 130, something like that.
129.5.
Genuinely? Yes.
But
let's round it to 130.
The point is, if you now take away what has been at least the right direction in terms of debt to GDP, it's that what will worry Brussels most.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.